We're long-term investors. You're a long-term investor. You tend to run a pretty concentrated portfolio, but then all of a sudden consumer trend may shift. How does that impact you and how you invest?
I spend very little time worrying about fashion trends, but I spend a lot of time worrying about business models. I really try not to be scared by macro. I think luxury is very interesting. We are going through a difficult period, but actually these brands are enduring and can go unscathed through cycles.
Well, that's a great lesson in investing is invest through a cycle, invest for the long term. Think of those secular stories as opposed to try to time the market with different macro factors. What's another idea that you really have conviction on today?
Yeah, so what I've learned is that
today, I'm joined by Lara Pellini, who's a portfolio manager in equities in London. Lara's been at Capital Group for 23 years. Welcome. Thanks for joining.
Thanks for having me, Mike.
All right. So, Lara, you joined in what is now known as our CAP program. It was originally TAP, but now it's CAP, the Capital Associate Program. Tell us a little bit about coming into Capital Group and why you joined us.
Yeah, so first of all, I joined September 11, 2001, Mike. So what a day to start, 9/11.
Wow.
And what tipped me into joining Capital Group was exactly TAP, the associate program, which is a 2-year rotational program where we have 6 assignments lasting 4 months each, and we have the ability to work in different areas of the organization and in different geographies. And by the time I joined in 2001, TAP had been around for almost 20 years. But what really tipped me to join Capital and TAP was that it was the first year that we had the opportunity to do a volunteering assignment. And this was something that actually touched me deeply.
And the volunteering assignment was 4 months in length. It was the same length as all the other ones.
Absolutely.
Okay.
And we were paid by Capital to work for a nonprofit of our choice for 4 months. And this was a big statement of intention for me. I've always loved research and I was fascinated by the investment world, but I was also a little bit put off by, the speculative aspect and the short-termism that is often associated with our industry. And so the fact that this program was offering me the ability to work for 4 months for a nonprofit of my choice, and I choose Merlin, which is an international health organization based in London, it really did it for me. It tipped me to join.
So in the CAP program today, 20 plus years later from when you were doing it, is that sentiment around community and nonprofit participation, does that still exist in the program today?
It is still in the program, indeed.
It is a good reason to join any company is the culture. And clearly, nonprofits and community are part of our culture. So it got you here 23 years ago. I'm glad that was added to the program then. And
I've been involved in the Capital Contribution Committee ever since. And last year we donated $50 million to more than 5,000 organizations. So that makes me really proud.
That should. I think the total number of Capital Cares donations globally over the last decade is about $350 million. So great. Let's get into, you said you like to do research. And when you say you like to do research, you mean it. Folks do research in different ways. You like to get your hands dirty. And I have a picture.
I know.
I have a picture here for you. When I say your hands dirty, I mean like really dirty. So for those listeners, we have a picture of Lara at Tesco, and there are 2 different parts of her work there. One is as a fishmonger, and you have a big old fish in your hands there, and the other's pushing a cart full of different boxes, and it looks like you're in the fresh food aisle. So why were you there? What were you doing? When was this? Give us some perspective of this primary research that you were doing.
As you can see, I really love to get my hands dirty. And my first industry review was about European food retailers. So it's a very tangible sector. And everyone was telling me, Lara, find your edge, think outside of the box. And so I thought, maybe I can do something that is a little bit different. And, it was a given that I had to read the annual reports and that I had to know the financials of the company. But the rest was left up to me. And so I thought, you know what, I'm going to ask if I can work in the stores and use my languages. And so I asked, and at first the companies were a little bit puzzled because no one had asked that before.
Right.
But then they realized that, at Capital, we have a very long-term investment approach. And so I didn't want to do it to get an edge on the next quarterly results. I was really there to understand the style of management, the culture of the companies, to understand a little bit more about the business model and the jargon. And so I did it first with Tesco, very grateful for that in UK, and then I did it in France and in Germany, which were the main markets that I was.
So you were working in, taking orders, whatever. Were you cutting the fish? Were you? Did everything.
I did a little bit of everything, in the photo that you showed before, I was stocking shelves. Then in the other photo as a fishmonger, by the time they took that photo, I think I was giving away my father's fish recipe. And I really became like the Italian fishmonger.
I'll bet they wish they had you longer term. I'm glad you came back and stayed with us. But even when you transition into portfolio management, you still wanted to do that kind of primary research. We have a couple more pictures of you. And one of the pictures for those folks listening is Just Eat, where Lara's about to get in a car, a Just Eat car, and deliver some food. And the other one is on a bike for Deliveroo, where you have the whole outfit on and you're riding your bike through the streets of London delivering food. When were these pictures taken, and why do you continue in that approach?
Yes, I mean, the lessons learned were so valuable for me when I did it the first time around that I really made it as part of my investment process to have a real world touch point into my investment approach. And so you're right that it's not always easy to do the same when you transition as a portfolio manager. But back then, when these pictures were taken, I was actually very intrigued by the food delivery companies. And the model, and we had a few investments in a few of them, and the model was transitioning from a very asset-light marketplace model to a food delivery model. But it was a new model, and so it had to be tested, and the unit economics were not clear at all. And so it was predicated on a few variables: the average order value, the commission rates, but most importantly, the labor cost and the number of drops that a food delivery drivers could do per hour. Now, Mike, on paper, it seems very easy. How many burgers or German kebab donors can you deliver in an hour? On paper, you would think I can do 3, 4, 5. In reality, 2 drops per hour were needed to break even, and you needed to move to 3 to actually move into profitability. Very easy to put this number into a spreadsheet, and then you have amazing profitability. And so I thought, let me actually go and try. And when I went, I love cycling. So I went with my bicycle and enrolled as a delivery driver, first in London, and then I did it by car in the northern part of the UK. I realized that actually to do 3 drops per hour was very difficult. And
just the logistics of going to pick it up, wherever you had to go to deliver, waiting for the people to sign for it, it just takes time.
It takes time. And so I came back and I basically came up with a list of variables and markets that were better for that model to work. Of course, density of the population, but also how many orders certain markets do. The Middle East, people were ordering something like 30 to 40 orders per year, very different from the UK at the time. And then another aspect that also came from that time was tipping culture. People were very friendly with me and they were happy that I was on time and polite, but actually they didn't tip me. And if I had done the same in Canada, people would have tipped me. And the tipping is very important because the customers basically subsidize the order for the employer. So very, very valuable lesson once again.
And I'm sure the tipping also keeps the employees there longer because they're generating higher income.
Absolutely. Actually, I was earning £3.50 per drop. And the national minimum wage, it's just above £11. So I just needed to do 3 drops per hour.
To hit minimum wage.
Exactly.
God, that's interesting.
Plus the tip.
Plus the tip.
Which I didn't get.
Which you
in
didn't
this
get.
case.
Okay. You love fashion, and growing up in Italy, I know that your mother had a store. Is that why you love fashion? Is it because you're Italian? Like why do you love fashion? And tell us a little about that.
You know, it's right. I love fashion beyond trends, more as a form of self-expression and individualism. But also, my mom had a boutique in the village in which I grew up, in the countryside of Tuscany. And I used to help her. And she used to be everyone's personal shopper. People would knock at the door at every time of the day or the night. Even at Christmas, people would come and seek her help because maybe they had forgotten a gift for their beloved ones. And so definitely the love for fashion comes from my mom. And as a child, she used to bring me to Pitti, which is an international fashion trade that takes place in Florence every year. And she used to bring me to the kids and children's version of it called Pitti Bimbo. And
So how old were you at the time?
I was maybe 7, 8.
Okay.
And I could really appreciate it, and I loved it.
So when you think of luxury or retail, it's really a consumer-driven, trend-sensitive business. And trends come and go. So how do you think about that? We're long-term investors. You're a long-term investor. You tend to run a pretty concentrated portfolio. But then all of a sudden, consumer trend may shift. How does that impact you and how you invest?
So, as I said, I love fashion, but when it comes to investing, I spend very little time worrying about fashion trends, but I spend a lot of time worrying about business models. And, business models are enduring, fashion trends are fickle, they are transient, as we know. And so I'll give you an example, Mike, that maybe can bring it to life. One of the companies that I have covered during my career and invested is Zara. Zara belongs to Inditex. It's a fashion group. It's one of the leader in apparel retailers. And I would say they're the most innovative and disruptive retailers in the world because they have a business model that is predicated on a very strong distribution, but above all, a proximity of sourcing. So they manufacture the products close to the consumer. So they can read the trends, see what is selling well, what is not selling well, and actually replenish on time. They have a very low inventory commitment, and they're really good open to buy. So if people would like your sweater, Mike, and they say, yeah, it's selling really well, they might want to do more of them, but they might not do it in the same color. They might decide to do it with a different textile, with a different fabrics, because we don't love to walk around and all, look alike.
Right.
And so it's a very unique business model. And in today's society where we speak about the importance of de-risking the supply chain and onshoring, this is such a contemporary model. And yet the company was born in 1975. It's 50 years old. And, how many fashion trends have we had since then? But they have such a model that is able to capture them.
And so other ideas, maybe give me 1 or 2 more ideas. The only rule is you can't have an open order on the trading desk to buy or sell it. But what's another idea that you really have conviction on today?
Yes, maybe I'll mention EssilorLuxottica because an area that I find particularly interesting is the crossroad between consumer, healthcare, and technology. And EssilorLuxottica is the global leader in eyewear. And I think this is a market that will change a lot thanks to digital technology, but also maybe thanks to artificial intelligence. The eyewear market is only $100 billion market, which is a fraction of what the sneakers market is, which is several hundred billions.
That's lower than I thought. It's a $100 billion global market. I would have guessed it was bigger than that.
Exactly, and that's my point, Mike. I think that is the market will grow. Maybe we have we have worn prescription glasses forever. I think the first pair was probably invented in the 13th century, but and they're still looking traditional. But I think in the next few years we might have glasses that are connected, and they will really enable to solve consumer needs that are not solved today. I could be talking to you in Italian, Mike, and you could hear me in English. It could solve the problem of my family. You know, I married a German, and
Lifetime translation
and
at
I
the
live
dinner
in
table.
London, exactly, and we are constantly doing translation to each other. So a connected glasses could do that for us, but also think about hearing aid solutions. There are more than 1.2 billion people that have mild hearing loss, and they would actually not use any hearing aid solution, either because it's a stigma or just because they can live, not ideally, but can do without it. And actually, we are now seeing glasses that have an embedded hearing aid technology inside the frame.
Wow.
So that actually I'll be able, you're talking, Mike, to me, and by looking at you, I can hone into what you're saying and tune out of everything else, of the background.
Well, my wife would be very interested in me getting these for my hearing. So, Chris Ann would be happy if I got these so I could hear a little bit better.
And my teenager son as well.
She says I have selective hearing. Who knows? And maybe one more company that you have high conviction in that you could see holding for a long time.
You know, I think luxury is also very interesting. And here I would differentiate from the brands that have really invested and have built an enduring franchise, and the one that have not. And we are going through a difficult period from a macro standpoint. This can happen from time to time, but actually these brands are enduring and can go unscathed through cycles. And so, you know, there are a few: Richemont, LVMH, Moncler,
So you
Brunello
like them,
Cucinelli,
you
the
like them
true
long
luxury.
time. And the difficult macro environment, a little of that is China demand, or is it growth? What is it today that's preventing them from doing
China
even
has
better?
been a
China's
big
been
growth driver,
right.
so we are seeing definitely a slowdown there. But also, you know, coming out of COVID, it's a bit of a different cycle that we have seen before. Maybe we have gone through a little bit of indigestion, and we just need a period of normalization as well. But this is a normal period of adjustment. This remains a structural growth story.
So secular long-term story.
Exactly.
You mentioned Moncler, and I'm glad you did. We didn't set this up, but in our office treasure hunt, I did have this individual, and for the folks who are listening and can't see this very large Moncler man with sunglasses, what is it? Explain it to folks, if you would, and why is it in your office? And I'm going to put it on the table here between us, and I'll ask you to share a little bit about it.
Okay, so maybe let me describe what people listening to the podcast are actually, and they can't see it. So we have this is a 19-inch statuette, so 48 centimeter, of a cool-looking bearded man wearing sunglasses and wearing a very eye-catching metallic puffer jacket with drip-painted bottom joggings and boots. Now, apart from the fact that it looks quite cool, don't you think, Mike?
Could you see me dressed like this, though?
Yes.
Probably not. Oh, yes. Yeah. I had an instant no for myself, but go ahead.
And so it's actually a little mascot that is in my office. And this was a collaboration that Moncler did with a New York artist. But apart from that, the reason why I like it so much is that during a client meeting, one of our investment specialists wants to describe my investment style. And I guess Capital Approach said, you know, Lara would never sell Moncler when the winter is mild. She would only sell Moncler if the franchise is broken or the brand is damaged. And I think this is so clear. You know, we have the power of investing through cycles for the long term. And the core of what Moncler sells is exactly these beautiful, luxurious puffer jackets. And so a mild winter might mean that they might go through a few patchy quarters. But, you know, that doesn't change.
So you'll hold this company unless the fundamentals really do change, unless something changed with their strategy, if you didn't trust management any longer, but not because people bought fewer puffer jackets in a mild winter.
Absolutely.
That's great.
That's
Well,
the message.
I'm glad you let us borrow this from your office. I appreciate that.
And it's easier said than done. This is why I want to have this mascot in my office,
So
to
you
be reminded
remind your
every day.
Yeah, I got it. And maybe talk a little bit more about those macro factors. So you're, again, a concentrated portfolio, high conviction. You own a certain number of stocks, typically 30 or 40, I think.
Below 30.
Okay, below 30. And then the macro environment in general, regardless of a mild winter for Montclair, but broader interest rates, broader economic growth, how do they impact you constructing a portfolio, or do they at all?
I like to have a macro and geopolitical overlay to my portfolio, but saying that, I really try not to be scared by macro. And I really learned these lessons during my time as a retail analyst. We discussed Zara, and Inditex was a fantastic investment during the Spanish recession. But even before that, in the 90s, I was covering H&M, and the share price tripled during the Swedish recession. And the reason was due to the fact that they were just the early innings of their international expansion. And so it taught me a big lesson. Macro is important, of course, and we have an incredible team that study macros, but I don't want to impact my investment decision, because I think that product innovation and market share gains are much more powerful. And, bringing it to today, as you know, I'm Italian, and people move from having a love affair with my country to absolutely hate it and be scared by it. And so what I've learned is that it's very easy to be negative on Europe, and the EU construct is very fragile, but actually that gives us so many opportunities, because there are so many gems of companies out there at trading at very low valuations. And because of macro, we are given these opportunities. So I don't want to pass on them.
So on the Sweden example, again, if you looked at the Swedish recession, you'd say, don't own anything in Sweden.
Yes.
And instead you found something that tripled based on the fact of what it was doing as an entity, as opposed to what the macro overall environment was.
They had a very differentiated business models, and they were taking share from the mom and pops, and that was much more powerful than anything else.
Well, that's a great lesson in investing, is invest through a cycle, invest for the long term. Think of those secular stories as opposed to try to time the market with different macro factors. When you transition to a portfolio manager, I think in an investment meeting, someone said you like to, quote unquote, stay close to home, meaning you have a level of comfort, and that helped your transition and your style as a portfolio manager. Explain that to folks. What does that mean, staying close to home?
Yes, I have a very intuitive, gradual approach, which I've used to move from an analyst to a portfolio manager, which means that basically I love to understand what I own. And so I knew retail very well. And at the time, retail was being disrupted by online. Consumers were starting to shop in a multi-channel way. And therefore, I realized that, especially countries that were based on a cash economy like Italy and Germany, they had to move their payment methods. And all of a sudden, I started to be interested in payment. And I remember investing, as I started, in one of the portfolios in this company called Adyen, which in 2018 was just around 7 billion market cap. And they had a unified payment method that was agnostic to the channels. And so this is an example in which I went from retail to payment. And the payment companies were somehow disrupting the banks. And so I started to look at the banks. And so it is a very gradual approach, step by step. But it's incredible, Mike, how, a few months and a few years later, you look back, and I'm very far from home. So
Right.
I got to healthcare, and I got to utilities and semiconductors and so on.
So staying close to home doesn't mean that when you grew up in retail and luxury, it doesn't mean you stuck with that. It just means your gradualistic approach and how you invest. That's more staying close to home. It's not having you're not massively overweight the area you came from.
No, not at all. And maybe, can I give you another
Yeah,
example?
please.
Maybe the other, as an analyst, I used to cover countries in Latin America, Europe, Eurasia. And I really love to use this pattern of recognition and ask myself, what am I paying for this company in Mexico, which is very similar to this company in Poland or in the UK. And somehow this comparatives model remains part of my investment approach. So I remember in 2019, I was visiting healthcare companies with our healthcare cluster team. And there are some unbelievable companies in the US, and we were looking at the NASDAQ Biotech Index, which back then was close to 800 billion.
The whole broad NASDAQ Biotech
market
Index.
cap.
Okay.
And then I came back to Europe and I'm like, how big is the biotech market in Europe? And you know what? It was 60 billion market cap. And there were maybe less than 6 or 7 companies that had a market cap above 3 billion. But at the same time, our analysts were telling me that some of the blockbusters like Humira for AbbVie or Keytruda for Merck had actually origins in Europe. And think about COVID and how many vaccines have come from Europe. And so somehow I thought, you know what, this is not right. This market has to grow.
It shouldn't be less than 10% of the size.
Absolutely. Right. And so I actually, this is an area where definitely I don't have an expertise in biotech, but I got myself the best people that we have at Capital, and we started to tour around Europe and in search of the Vertex or the Regeneron of Europe. And actually, I think we had some really good successes in doing that. And some of these companies have stayed in my portfolio since then.
Another thing that you do as a portfolio manager now is you adopt what people know as broken stocks. Something happened. Something went wrong. The stock's down 20%, 30%, 40%. It may get orphaned in some way, shape, or form. And you find those companies. What do you look for them? Do you just proactively say, has something fundamentally changed, or is it another driver on why the stock is down so much? Why do you adopt broken stocks?
Part of it might be the fact that I have a very low turnover. And
what is your turnover? Maybe
single digit.
Single digit. Okay.
And so I am very patient. I'm sure if you'd ask my son Rocco, he would disagree with me saying that.
Less patient at home, more patient in your portfolio?
But when it comes to investing, I'm very patient. And so because I love to really get to know the companies that I'm invested in, and as I said before, there are many mild winters, but often it just maybe might take a bit longer. But if something is not broken and if the investment thesis is still intact, I'm very willing to adopt it. And especially if it's a company that I already owned, I feel I know well, and so I'm taking it over from others. And actually, JL used to do something which was a little bit similar.
JL, so John Lovelace, who helped manage capital for around 40 years.
He used to accommodate the market. So it was slightly different. He would accommodate the market in the sense of buying from others what they were selling and selling what others wanted to buy. So it was accommodating market cycle. So slightly different, but I feel I'm in good company. And when I accommodate or take over these companies, it never feels good. Usually the situation is a bit dire, so you need to feel a little bit brave, and I love to think that I'm in good company. And JL.
John Lovelace, that is very good company. And broken here just simply means broken share price, not broken fundamentals.
Absolutely.
Right.
When the investment thesis is broken, I have to move on. I have to be intellectually honest and say I was wrong.
Mistakes made. This is the humbling part of the conversation for everyone. And everyone says there's too many to count, but I'm going to ask you to share one. Maybe what happened, a lesson you learned from a mistake you made, whether it's early in your career or last month. Tell us about that.
I'm going to tell you about a mistake that I made during the GFC, or rather a big lessons learned, I would call it. This was a Mexican food retailer. It was a company that had been around for so long and had a a very well-respected founding family behind as well, is a company that actually went through the Mexico tequila crisis in '94 unscathed. And so I was not worried about balance sheet or bigger risk outside of the fact that they were selling,
Management? Were you worried about management?
not really, not really. But what it turns out is that actually they had taken bets on a strong Mexican pesos. And so they had done some derivative investments. And during the GFC, the Mexican pesos devalued at a very rapid pace, and they couldn't actually fulfill their margin calls. And the more losses they had, the more they were trying to hedge these losses. So the big lessons learned for me, even if it would have been a bit difficult to actually spot it, is to spend a lot of time, even when you think you're dealing with a plain vanilla company, looking at off-balance sheet commitments, how much of the debt is denominated in the currency, which is not the currency of their operation. And, it was a mistake, and I felt terrible. I remember I wanted to resign. And someone told me,
Someone tapped you on the shoulder and said, everyone makes mistakes.
everyone makes a mistake, don't resign, but write a big piece on lessons learned. And actually, years later, he'd helped me to avoid a Brazilian blow-up of a company that actually had taken a lot of US-denominated debt when we were worried about the Brazilian real devaluing. And similarly, I discovered that a lot of my retailers that had that they were operating in Eastern Europe actually were taking rents in dollars. And so again, I didn't like that mismatch.
Moving away from that core operating business and having, whether it's currency risk or debt risk or sometimes even an expensive hobby that takes them away from their core business, that kind of thing is where you can go astray.
Absolutely.
On the other side, you do have a unique investment edge. I know we talked earlier about getting your hands dirty and delivering food and working at Tesco to get a sense from them. Is that your edge, or how would you, in your own words, describe what your investment edge is?
I think it is my edge. It's really kicking the tires, getting my hands dirty and going deeper, and this relentless commitment to do it. Whether I'm an analyst, whether I am PM, I'm actually, I have a secret project now. I can't talk to you about, Mike, but it's kind of a long...
You can't tell me you have a secret project and then not tell me what your secret project is. All right, will you tell me after we're done filming today?
I might.
Oh.
Yes, and also as a PM is definitely partnering with the analyst. We own the company, we don't rent the company. There are no silos, and so we have the beauty of being able to partnering, sharing nuggets, and connecting the dots. But you have to connect the right dots, and so I feel my job is really to find those dots, maybe uncover them. And, my friends take the Mickey. They say that I'm a bit of an explorer, and they tell me I'm a mix of Dora the Explorer, Indiana Jones, Marco Polo, and Lara Croft. So
I think that's a fair comment. Maybe we can get that visual up at some point. I like that. But you are a mixture of all of those things. All right. So to finish up, we have our obsessively grateful moment where I get to share with you what I've always termed as the world's largest mug. Now, our team reminds me that, in fact, this is not the world's largest mug. The world's largest mug, and it's on the screen behind us for those who are listening. Maybe this will encourage those folks to watch on YouTube, but it's 10 feet by 11.5 feet, and the world's largest mug fits 7,116 gallons of coffee. So clearly not the world's largest mug. The one that we share fits 16 ounces of coffee. But Lara, for you, we're going to share with you the 4-ounce espresso mug. So this is a special one created just for you as you share with us what you're obsessively grateful for.
This is incredible. Grazie mille.
Prego. And for the other mug, which is not the world's largest, but I think you'll use it for other things. Please enjoy.
I think I'll use it as a vase. What about that?
Enjoy.
I will drink my espresso in this one.
When I visit you in London, I hope to see flowers in that.
You will. I'm obsessively grateful for my family, my friends, and my village. As people say, it takes a village to raise a child. And I feel so grateful that I had that village, which is the place I grew up in Tuscany. And I'm grateful that they let me go and made me fly. I was an only child, so it wasn't easy for my parents to see me go away, study, and follow my dreams. And now that's the place where I really love to fly back, where I recharge, and where I find myself again and again and again. And I hope you can come and visit.
I want to visit. By the way, I'm grateful for you because as we've talked about offline, you've been a great advisor as my wife and I are going to celebrate our 30th anniversary. And you've helped me really get a great Italian vacation plan for us for our 30th anniversary. So thank you for that.
Thank you. Love a
Grazie
great
mille.
time. Oh, prego.
So thank you for coming on the podcast. I appreciate it. You have great energy. We're fortunate to have you here. We're fortunate to have you managing money for our clients. And we're also fortunate that you're such a great hallway mentor and you help the office just be a great place to be. So I appreciate that. And I appreciate you. Thanks for joining us, and please subscribe to Capital Ideas on YouTube or wherever you get your podcasts. Have a great day.